zero DTEs. Trading zero versus one DT options. We haven't traded any zeros or any one DTs or zeros in a couple of days now, but we do trade them from time to time. Just Vol's so cheap that I backed away a little bit.
Because the strategy you were using, which was an iron, which was a
cheap Vol.
Butterfly, they get more expensive as volatility goes lower, but they've been hits because we haven't moved.
Now we can do more stuff. Look at this little rally here, up 14. This is about the high.
As high as we've been.
It's the high as we've been yesterday. I think we got up to 85.
You're above yesterday's. Yesterday's high was like 41.79.
No. It's 41.80 something. Oh, don't question me. There's certain things the way my mind works. Some of them are highs for yesterday.
Okay, was yesterday the 17th? Does the high say 41.79 there?
That's wrong.
That's okay. Thank you.
It was over.
You think I just pop out the number like I just you don't think I'm looking?
It's wrong.
Obviously.
It was the high yesterday was 41.84 or something.
Sure it was. Okay.
Oh.
You're right, my lord. The emperor has new clothes. You look very nice.
It was. Anyway, trading zero versus one DT. Some things I could be wrong about, but some things I'm never wrong about.
This is one of those things you're never wrong about.
Mm-hmm. Compared to any other expiration cycle, the zero DTE options have the greatest single day risk reward. I don't think that surprises anybody, with roughly 100 times the exposure of the 45 DTE options. Now, we've talked about this. 45 DTE is kind of our go-to. So why is that our go-to? Because it keeps everything consistent. It gives us, it standardizes duration for us to give us a chance for our strategies to work. Okay, for a long time in this show, we've said duration over direction. Okay, and the 45 days gives us that standardization. With the zero DTs, you have no duration, so you're basically just you're just rolling the dice. You're flipping a coin.
Right.
But just to put stuff in context, you have 100 times the daily exposure of the 45-day cycle. So how does the risk and exposure compare to the one DT options? So how does zero compare to one? Want to take a guess? If you had to compare 0 to 1, what would you say, risk-wise? It's half the risk. It's a third the risk. It's a quarter the risk.
I think it's going to be
80% of the risk. I don't know.
I think it's going to be. I think 0 days will have more risk, maybe 2 to 1. I mean, if you're going to get out
so you're saying it's got 50% of the risk.
Yeah.
So realistically, the way options work, it's kind of it should have about the zero.
It's an extra day. It should be. I'm just going one day. I'm going 50%.
I'm agreeing with you. I don't know the answer to, but I think that it's if you go with one DTE, let's say that you should have 50%.
One day has to have value to it.
If you have 100 times more daily exposure than a 45-day, if you have 1 day DTA, it should be 50 times more. Okay, because it's not going to be like 85. It's going to be dramatic. If you go to 2 days, it's going to be like 25%. 25 times more. So, how does the risk and exposure compare to the one DTA? Because that part of the slope is brutal. Let's go to the next slide. So we did a study, and we compared the following strategies in the 0 and 1 DT cycles. We initialized at open. What that means is we put them on first thing in the morning. All right. So we sold a straddle, which is the max exposure, right? That's the at the money.
Sure.
We sold a straddle, and we then also did this in SPY. So it's 1/10 the size of the SPX. And then we buy the $3 wide butterfly. And the reason we do the $3 wide butterfly is because the 1 day daily move has been somewhere between $20 and $30.
And the straddle uses a lot more buying power. I mean, you're looking at one trade that uses a lot of buying power and one that uses less.
Well, the straddle, but the $3 wide butterfly in the SPY is the same as $30 in the SPX. The reason we do that, again, is because that's just outside the expected daily range, which is $3 in SPY. So we recorded the P&L change in the first 2 hours of SPY moves plus or minus 5%, which that's within the expected move. And if it moves 1.5%, 1.5% or 1.5 standard deviations, that's outside the expected move. And so we took a look at that. And obviously, like today, we've been inside that expected range. Let's go to the next slide. Okay, we get right into the meat of this. So the 1 DTE straddle is 66% more expensive, and the butterfly is 32% cheaper versus 0 DTEs. Okay.
Percentages. They're using percentages.
Yeah, they're using percentages. So if 66% more, so if a 1 day straddle, let's just say, was $3, I'm sorry, if it was $1, it would be $1.66. So if it was $3, it would be $5. So in other words, if you had 1 day to go and you bought the straddle, it would be, instead of $3, it would be $5. Right? That's 66% more.
Okay, well, it's like $2.50 right now, or you want to say $3?
Yeah, we said $3 just because.
Straddle is $3.
So what this first piece of research is saying here is if the straddle was $3 on 0 DT, it would be $5 on 1 DT. And the butterfly, if it was, let's just say it's $3 white butterfly, if it was $1, it would only be 68 cents the day before. Okay? So let's take a look here down below. So SPY 0 versus 1 day. And we're going to look at net debit and credits just for average prices. So the straddle with the 0 DT is 184, and the butterfly, which the straddle's a credit, and the butterfly, which is a debit, is boy, that straddle seems cheap. And that butterfly.
That's why I'm looking at it right now.
And that butterfly seems expensive. Oh yeah, but the 1 DT is 305. That's exactly right. And the butterfly is 97 cents, and the difference is 66 and 32. Even though it's just because volatility is so low now.
Yep.
I would have guessed that butterfly and 0 DT was probably right around that number, right around $1 something. And
$3 wide, about half the width of the strikes is where you would have guessed, or a little bit less.
Yep, and the day before about a third of the width of strikes. Pretty close. Let's go to the next slide. This is in super low volatility. For small moves in unchanged markets, the 0 DTs have double the exposure for undefined risk and 4 to 5 times the exposure for defined risk trades when compared to the 1 DTs. Let me repeat that because it's really important. For small moves in unchanged markets, the 0 DTs have 2 times the exposure, that's exactly what Bat said, for undefined risk trades, and 4 to 5 times the exposure for defined risk trades. Let's take
the 1 days.
Then the 1 days. So what we're doing, go back right there. So we're doing this in the SPY, we're comparing, these two. So here's the P&L effect on the inside the expected move. And you can see here, up or down, 5% or less versus unchanged on the straddle and on the butterfly. That's pretty much exactly what we're saying in there. It's just double the exposure versus 4 to 5 times the exposure.
Bet you were right again.
I mean, and where do you get 4 to 5 times the exposure? Well, 1 DT, the exposure is about $7, right? Inside the expected move. And on 0 DT, it's 32. That's 4 times, 4 to 5 times. And, anyway, just throwing the numbers out there and so they kind of make sense what everybody's looking at. And the other ones are half. Okay, cool. Let's go next slide. For big moves, because this is where people care the most.
Sure, because you can take care of everything else. It's inside the expected move.
Yes,
You're fine.
So big moves is where it's scary. So for big moves, the difference between 0 and 1 DT trades narrows because both get whacked. Now, remember, when you say both get whacked, when you have a big move and you are doing something, most of us are going to sell something or we're going to play for inside the range because that's just how we do things at Tasty. We're playing inside the range. So if you get a move outside the expected range, you had a huge move in the market, and that's always going to be bad for us. But that's going to normalize both trades. So 0 DT trades have a 25% greater exposure for undefined risk and 75% greater exposure for defined risk. A lot of
why
times
do you think defined risk is so much more than undefined risk?
Because defined risk is so much narrower. You know, like here, think of this. If you're doing the straddle, you have
You're getting about the expected move.
or outside of it when you talk about the premium.
Yeah.
Okay. When you are doing the
Defined risk.
defined risk, you have to buy that out of the money option.
Yeah, the wing
The
cost,
wings,
yeah.
those cost you money. That takes away space. So, outside the expected move here, so up or down 1.5%. If you look at the straddle versus the 1 day, it's we just threw the numbers up there. It's 75% more on the butterfly, and that's if you have the move out either up or down more than 1.5%. So what would today qualify? Well, today's still an inside day. I mean, right now, as I'm doing this segment, the S&Ps are up 18.
The half a percentage point.
Yeah,
right?
the Nasdaq's up a little over 1,
Yep.
and the Russell hasn't really moved at all.
Yep.
Okay, let's go to the slide of takeaways. So zero DT trades carry between 2 and 5 times the exposure for both profits and losses on days where there's an immediate move inside expectation when compared to 1 DT trades. So basically, we're talking about if you move it ahead a day, you take double the risk. If you move back a day, you take half the risk. And that's the easiest way to think about it. Large moves cause both 0 and 1 DT trades to have significant losses. However, the 1 DT loss is roughly 50% less because it could come back. And on the 0 DT, there's no coming back. But we're not making the case here for 1 DT over 0 DT. We're just presenting
The risk involved.
that it reduces the risk. Like, there's no theoretical advantage to a 1 DTE versus 0 DT. You're just putting up less money to make less money.
No, but if you're thinking about dabbling in 1 or 0 or tighter time frame strategies, and you're a little bit more risk adverse, the further out you go, obviously, and 1 day versus 0 days, the only one we went to here, you cut your potential risk in half. Now, of course,
Yeah.
it's linear. Your potential profit gets diminished too. So it's the same. Hey, EQR, which is the equity residential that Sam Zell started. Sam Zell passed, sounding off about 15 minutes ago. So rest in peace, Sam Zell.
EQR?
Yeah, EQR. It's
What's it doing?
it's halted. They halted it.
Sam Zell, how old was he?
81.
That's it? Saw him in line at the, never met Sam Zell.
Walgreens.
No,
was
never
always
met
at the
Sam
Walgreens.
Zell. Saw him in line at the Department of Motor Vehicles. He's waiting in line like everybody else. There's 1 or 2 guys came up and talked to him. I didn't say a word to him. I just said, he's the grave dancer.
The grave
He'll dance on your grave.
dancer. That's right.
Grave
That's right.
dancer.
Right. He would take businesses that were defaulting and turn them into something pieces wise. Yep.
The grave dancer.
Yep.
He was your uncle, right?
No, but one of the original investors of the world. I mean, started in the 50s and 60s, I would imagine, right? Anyway, Sam
Zell, good Chicago boy.
Yep. We'll take a quick 90-second break. We'll come back. We got more Tasty Live after this with Joy. Mr. Scott Sheridan next.